Decoding the art of stock price manipulation. Have you ever wondered what it takes to manipulate stock prices? Although it may seem daunting and complex, the art of stock price manipulation is quite simple once you understand the fundamentals. In this video, we will be decoding the art of stock price manipulation and exploring the various methods and techniques that can be used to influence stock prices. We will also discuss the legality of these tactics and provide some tips on how to avoid being taken advantage of. Illegal practices used to manipulate stock prices. Stock price manipulation is an illegal practice that can distort the value of a company's stock. Investors often resort to these techniques to make a profit by artificially inflating or deflating stock prices. Manipulation can have devastating effects on investors who are unaware of these fraudulent practices. One of the most common techniques used to manipulate stock prices is known as pump and dump. In this practice, individuals or groups of investors purchase large quantities of a particular stock and then promote it aggressively. The aim is to inflate the stock price by attracting other investors to buy in. Once the stock price has increased significantly, the perpetrators then sell their shares at a profit. This leaves other investors holding shares that are now worth significantly less than they paid for them. Another illegal technique used to manipulate stock prices is known as spoofing. In this technique, traders create the illusion of market activity by placing false orders to buy or sell stock. This false activity creates an impression of increased interest in the stock, causing other investors to buy or sell in response. Once the stock price has been artificially inflated or deflated, the trader cancels their false orders and cashes in on their profitable trade. Other techniques include insider trading, where individuals use their access to privileged information to trade on stocks before the information is made public, and naked short selling, where investors sell stock they do not own, hoping to buy it back at a lower price and make a profit. What drives stock prices? There are several factors that influence stock prices. Some of the most significant factors include the financial performance of the company, industry trends, and the overall state of the economy. In addition, geopolitical events, changes in government policies, and global market conditions can also have a significant impact on stock prices. The financial performance of a company is one of the primary factors that investors look at when evaluating a stock. The company's revenue growth, earnings per share, EPS, profit margins, and cash flow are some of the key metrics that investors analyze to determine if a company is profitable and has growth potential. Industry trends can also play a significant role in determining stock prices. For example, a company operating in a high-growth industry may attract investors who believe that the company will benefit from increasing demand and a favorable market environment. In addition, the overall state of the economy can also have a significant impact on stock prices. For instance, during a recession, investors may sell off stocks due to concerns about a decline in consumer spending, high unemployment, and weak economic growth. On the other hand, during an economic expansion, stocks may rise as investors become more optimistic about the overall business climate. Geopolitical events and government policies can also affect stock prices. For example, a trade war or a major international conflict could lead to a decline in stocks. Likewise, changes in government policies such as tax reform, regulatory changes, and changes to interest rates can also impact the stock market. Global market conditions can also influence stock prices. A major economic crisis in a foreign country, a decline in the value of the dollar, or a sudden rise in commodity prices could lead to a decline in stocks. How do investors get burned? Stock price manipulation can have serious consequences for investors who fall prey to it. Here are a few ways that investors can get burned by stock price manipulation. 1. False optimism. Manipulators often use tactics to create a false sense of optimism about a particular stock, which can lead investors to believe that the stock is a good investment opportunity. This can lead to investors buying up large quantities of stock at inflated prices, only to see the price plummet shortly thereafter. 2. Pump and dump schemes. In these schemes, manipulators artificially inflate the price of a stock by hyping it up and creating a buzz around it. Once the stock price has risen to a certain level, the manipulator will sell their shares and pocket the profits, causing the price of the stock to plummet. This leads investors who bought in at the higher price holding the bag. 3. Insider trading. This illegal practice involves using non-public information to buy or sell stocks before the information becomes public knowledge. This can result in artificially inflating or deflating the stock price, leaving other investors unaware and at a disadvantage. Investors can protect themselves from falling victim to these practices by doing their research, paying attention to the market, and avoiding stocks that seem too good to be true. It's also important to have a diversified portfolio and to not put all of your eggs in one basket. How do you avoid being a victim? Avoiding being a victim of stock price manipulation can seem like a daunting task, but there are steps you can take to protect yourself. Firstly, you should do your own research and due diligence when it comes to investing. Look for reputable sources of information, read company financial reports, and stay informed about market trends. It is also important to have a diversified investment portfolio. This means spreading your investments across different companies, industries, and asset classes. This will reduce your risk of losses in the event that one company or industry experiences a downturn. Finally, be wary of any investment opportunities that sound too good to be true. Be on the lookout for red flags such as promises of guaranteed returns, high-pressure sales tactics, or vague explanations of investment strategies. If something seems suspicious or too good to be true, it probably is. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.